Hey, Bowtie Nation, Joseph Hogue, thank you for being here. Got a really important live stream for you today. These market open Mondays, what we're calling them, we're coming to you 9 a.m. Eastern Time every Monday morning before the market opens. Really get you ready for the week, what I'm watching in the markets as well as the stocks I'm watching, some of the trends and strategies you need to know about. And it is an important week because all the three indexes broke their 2 week win streak last week. The Nasdaq was actually down almost 4% last week, so really kind of reaffirmed that downward trend. We got a lot of really negative commentary from the Federal Reserve, especially from one member in particular that really sent a shock through the market, made people think that the market is going to fall quite a bit further. So I want to talk to you about what I'm doing with my own portfolio, how to invest in this market, how to protect your money, and whether you should, whether we get better prices on the way or a full-blown recession that's going to send stocks crashing. I see a lot of people from the Bowtie Nation there already in the chat. Thank you for being here. I appreciate it. Love seeing you here every Monday and getting that face-to-face feel that we don't get really in the videos and that connection. Going to talk about the markets, sectors, and trends, what to watch, what we usually do here in the live streams, and then we'll leave room for that Q&A at the end of the live stream, part that I love the best, just really talking back and forth with you. Let me know if I'm coming to you all right, if the picture and the sound is coming to you, and we'll get started. Now, the topic for this week is really going to be that protecting your money in a recession. And it's actually from a blog post that I did with a bunch of other investing people on the blog, My Stock Market Basics. I surveyed 10 experts, 10 bloggers, 10 analysts, 10 professional investors on what they would do to protect their money during and before a stock market crash. So I'm going to share some of those with you. I'll leave a link to that in the description below if you want to check out that full post. Some great ideas and some great things some of these investing experts said. But I want to get started. And the important point here is, I think, there's two different kinds of investors. One that just wants the no stress risk, the no stress way to invest, the long term buy and hold. They've got maybe more than 10 years plus to invest until their retirement or until they need that money. And I think, I think what's important there is they just don't freak out. They just stick with those stocks that they really like. They stick with their strategy, and they don't let the market panic them out of their investments. Because if there's one thing that's always true, that's guaranteed to be true, is that the market will go higher eventually. After every single stock market crash bust we've had, stocks have eventually gone higher and beaten those record highs, right? So that's the one thing you absolutely know for certain. And that if you've got 10 plus years to invest, then that's when you're going to be able to take advantage of that. And ironically, the best thing about right now is everybody's panicking, everybody's freaked out and getting out of the market. Ironically, that this is the best time to invest. If you've got more than 10 years to invest, then this is the only time where you really know you're getting the best prices for stocks. Okay, it's funny, people love to invest going all the way up in in stock prices. People love to invest in a bull market, buying higher and higher stock prices, but then they get freaked out and they stop investing when stock prices come down. But as stock prices are going up, you never know if that's the peak. You never know if that is the top of that bull market and stock prices are going to come down. As the prices are coming down and as we go into that bear market, then you always know that stocks are eventually going to reach those peaks again. And so this is your chance to keep investing, create that habit of investing every month, keep investing and get those stocks at a better price. Now, of course, the other side of this is the people that maybe want to trade a little bit more, maybe want to take advantage of some of the trends and the strategies that we talk about, and so you don't necessarily have to hold to that buy and hold strategy. You can have your buy and hold part of your portfolio, your buy and hold stocks, but then you also have a part of your portfolio where maybe you trade a little bit more often. You get out before the worst of the stock market bear happens, and you make a little bit extra money there. Also, the people that have less than, maybe 5 to 10 years left to retirement. For those, it is very important to protect your money, to have that money there when you need it. Because, as we know, It took something like 14 years for the Nasdaq, for the tech stocks in the Nasdaq to get back up to that 2000 peak, right? So if somebody was retiring and planning on to retiring in 2005, and they had their money in year 2000, 1999, they really couldn't have withstood that stock market crash in 2000, because it would have taken many years to really get their money back after that crash. So for them, it is also very important to be able to protect their money, know how to invest their money during a stock market crash, and be able to go on from there. So we're going to get started here. I do have, if you want to see the stocks that I'm actually buying and holding, the stocks that I'm buying no matter what, and I'm holding, these are my buy and hold stocks. I've actually put a link in the chat there, and I'll put it in the comment or in the description below. The 7 stocks that are some of the biggest stocks in my portfolio. Did a free report with Motley Fool to make this available and show people really what's in my portfolio, what I'm buying no matter what, and what I'm holding. Now, of course, they're going to ask for your email. They're going to send you some emails asking you to sign up for Stock Advisor. I use Stock Advisor. They've got some great recommendations in the past, but it's absolutely free, no obligation, right? You just delete those messages when they come into your inbox, and you keep that free report, right? So I don't want you to feel obligated to buy anything or to keep anything. You just sign up, get that free report, and check out what stocks I'm looking at for the future. But I want to get started here because it does look like the market is going to open negative today. Let's look at where we are. We are down negative 1.3% for the Nasdaq futures. S&P futures are down almost 1%, about 0.75%, and that is a pretty significant sell-off in futures. So it will be a negative day. Crude oil is kind of surprising. Crude is down 4.5%, now down to $93 a barrel. This is something we've been talking about here on the channel over the last few weeks. We had that spike in crude all the way up to $120, $130 a barrel on the invasion of Ukraine, and that's really come down. So people are asking, should I hold on to those energy stocks, those oil stocks that have done so well lately? But should I buy more, hold on to them? What should I do, or sell? I own shares of Chevron. I own shares of Devon Energy, Diamondback Energy, ticker FANG. And yeah, I do believe, the oil prices are going to be lower from here. I've been talking about how oil prices were going to be coming down all the way from 120, 110. Here they are at $93 a barrel. Oil is just not, especially if we're looking at the prospect of a recession over the next year, oil should not be at $93 a barrel, right? It was at $80, $85, $75 before the invasion. And that's probably where, $70 to $80 a barrel is probably where it could fall down to. With that said, I am holding on to my energy stocks, right? Because these are just cash flow machines. Most energy stocks, most oil producers have a cost of production of right around $40 to $50 a barrel, right? Some of them, even Chevron is even lower, $35 a barrel. So they are making money hand over fist, even if crude prices come down to $70 or $80 a barrel. They are making tons of money, lots of cash flow. They're not investing it like they used to, investing it back into the fields, back into new exploration, because they see the writing on the wall. They know that oil demand is going to be down over the next 5 to 10 years, so they're really not investing in those long-term oil wells. What does that mean? They've got this cash flow and they're sending it back to investors. Dividend growth for oil companies is through the roof right now. So I am keeping those shares. I'm selling some covered calls against those, and we've got some option strategies, options investing videos on the channel. You check those out. See how to set up a covered call strategy, because it really takes some of the risk out of those stocks that their prices are going to come down, but it keeps you in the shares and it keeps you getting those dividends. Gold is actually up 1% today, up to 1967 an ounce. I think that might be maybe on dollar weakness. For gold, there's a lot of things that really matter for gold here. Interest rates, as interest rates go up, gold tends to lag. Gold tends to underperform because, holding gold, you get paid nothing while you hold it. You only get paid when you sell it. You only make that return when you sell physical or gold or the futures. So as interest rates go up, it tends to pull investors out of gold into those other safe investments like bonds and other things. So that getting that higher yield, getting that higher interest rate. So a lot of times when you see interest rates go up, gold will go down, or at least will flatline. The price of the dollar, though, too, very important for gold. As the price of the dollar either strengthens in times of uncertainty, like what we've had, or sometimes with an aggressive Federal Reserve for tightening and higher interest rates, that'll push the dollar up. Things like that. Those things push the dollar up and push the price of gold down. Now, when the price of the dollar weakens, like when that uncertainty comes off, if we start seeing some kind of negotiations around an end to the invasion of Ukraine, then the dollar is going to weaken, and that's going to help gold go up a little bit, because gold is priced in dollars. So gold keeps its value. Whether the dollar falls or rises really affects that price. Look at some of the other assets here. The 10-year bond, 10-year treasury rate up to 2.77%. And this is amazing. The interest rates jumped by nearly 0.5% last week, which that may not seem like much, but it is unheard of for interest rates to move that much in 1 week. Very important for what we're going to be talking about here today in how to protect your money in a crash. Bitcoin and other cryptos down pretty hard today, 3.5%. They were about flat for last week, maybe down a little bit, but down to about 41,000 a Bitcoin right here. I want to look at some of the sector trends before we get into kind of really what to watch and what the stocks I'm watching this week. Here we are on the sectorspider.com. It's going to show you the sectors, how the stocks in each sector, each of the 11 sectors did over the last 5 days, month, all the way up to 5 years here. Great resource for really just getting that bigger picture idea of where stocks are going. So we're going to click it over to 5 days here, and you do see, okay, so the S&P 500 did fall by about 1.5% last week. Pretty hard drop last week in the stocks. But what was really interesting here was the difference between the laggards and the gainers here. Usually when you see a market sell-off, you see a pretty broad market sell-off, right? So all the stocks in all the sectors, maybe except for one or two, end up going down and go down pretty much the same together. What we saw last week was that, yes, there were more losers. There were, so what do we have? 2, 3, 5 winners, 5 gainers, stock sectors, and then 6 losers, 6 stock sectors that closed lower. But really the difference in the two, we had gains of 3.5%, 3.2%, 3.5% in healthcare, 3.2% in energy, almost 3% in consumer staples. And then losses of more than 3% in technology, consumer discretionary, 2.5% in industrials there. So it was really amazing that some sectors sold off so much worse, while others gained quite a bit more. And I think it really helps to show where the market is positioning for a recession, for a downside in stocks, where the market sees safety in this market. Okay, so you've got a few sectors there. Consumer staples here that did 2.7%. You got utilities that did almost 2%. Those are really, and then real estate. Not quite as much real estate, but utilities and consumer staples. Those are really your safety sectors, right? Those are the sectors of the economy where the stocks, the companies within those sectors sell those really necessary consumer goods, right? You've got in the consumer staples, you've got food stuff, you've got personal health or personal packaging, personal products and household products, things that you have to buy for your house and for yourself, things like that. Utilities, obviously, natural gas, electricity. Companies that produce that thing that you have to buy, and they've got monopolies on their regions. So very stable cash flows from these two sectors, from the stocks in these two sectors. Very stable cash flows. They're generally a very high dividend yield. And those are really the ones that, if you're worried about a further stock market sell-off, those are going to protect you somewhat. I mean, that's not to say that in a full-blown stock crash, those sectors or the stocks in those sectors won't fall as well. But those are the ones that tend to fall the least. And we saw, they held up pretty well last week. If you do want to ever figure out what stocks are in a sector, then you can always go to this sectorspider.com. and go to this, and then you can click through. You click through any of these, and it's going to show you the stocks in the S&P 500, so the largest 500 companies based in the United States, in each of those sectors. So if we click on consumer staples, we see that we've got Lamb Weston, Kroger, which is grocery stores, Colgate Palmolive, which of course is those personal products and stuff. Constellation Brands is liquor, which we all need that. We all need beer and booze tends to do pretty well during a recession. You've got a lot of the Archer Daniels Midland, which is kind of weird there because it's more of an agricultural kind of thing rather than food stuff, but Walmart, Costco, Cisco, Walgreens, Boots Alliance, things like that. If you look in the utilities, obviously you're going to find a lot of those energy companies, the electricity companies. You've got Energy, and I hate that name, Exelon, Centerpoint. You've got some other popular ones here, Dominion Energy, Duke Energy, things like that. The companies that sell the things we need. Now, if you look at some of these others, how some of these others did, obviously. Energy stocks, so oil stocks, was really a function of the cash flows coming into those. Oil held up pretty well last week and was still up very high compared to last couple of months. So and then you look at the other side. Well, and then you look at healthcare. Healthcare. So what was really interesting here last week is the broadness of the healthcare rally. Okay, so healthcare. Within a lot of these sectors, you've got different industries, right? And you really need to think about it in different industry terms as well, because within especially within like communication services, you've got telecom, you've got internet, which are two very different. You got some e-commerce names in there, which obviously are two very different industries. Telecom is going to do well, going to tend to do very well during a recession because again, it's selling that wireless, those wireless cell plans that everybody needs even during a recession, and that you're going to keep. Whereas the e-commerce, the internet names in that sector, not so much. They're going to be very much more economically cyclical, and they're going to fall during a recession. So you really do need to look into these sectors for the specific industries within them. But within healthcare, you've got a lot of the biotech companies. So biotech, pharmaceuticals, drugs, those tend to be very cyclical and fall hard during a recession because they're much more like those growth stocks that you get in technology. But in healthcare, you've also got the larger pharmaceutical makers, the drug companies like Eli Lilly, Pfizer, AbbVie. You've also got the facilities, so the medical facilities and that kind of thing. And then you've also got the medical equipment makers, right? So different industries, and they don't always run together. The stocks in each industry don't always go up at the same time. But what we saw last week, which was interesting to me, was that we did see that. Okay, we did see not only the medical device makers, the drug makers, but we also saw the biotech, the biotech companies. We saw all the companies, all the industries in healthcare really go up at the same time, which is interesting because it really shows the real strength in healthcare right now. So I think that's another one where you could probably look for some protection here as stocks sell off, some relative protection there in healthcare. Obviously, the worst losers, the laggards here were technology. So you got those growth stocks, those high flying tech stocks, the consumer discretionary, which those are your retailers, your apparel stores, things like that sell things that you don't necessarily need. You buy them anyway because you can't help yourself, but you don't necessarily need them. So when the market does fall, then people tend to cut back on their discretionary products or services more than others. So you've got consumer discretionary, you've got technology, and then the communication services. So those internet names, the e-commerce names fell as well. So just a really interesting way to get that bigger picture idea before you drill down into specific stocks. Now I want to talk about what I'm watching for the week, what to watch as far as the markets. Really, what you got to understand, folks, is what happened last week. We had that big sell-off last week, really reaffirmed the downward trend, and a lot of it was because of comments from one particular Fed governor, Governor Brainerd. Very smart, vice chair of the Federal Reserve, very smart economist, but she came out very hawkish, very bearish on rate, or very bearish on what the Fed needs to do. Okay, so when you hear the Fed speak, or the Federal Reserve give commentary and stuff, people are going to say they're either dovish or hawkish, right? And Vice Chair Brainerd, she is typically one of the most dovish on the board. Okay, and what that means is she's typically very accommodative for low rates. She wants to keep rates low. She wants to keep unemployment very low. She's not quite worried about inflation so much, but she wants to be very accommodative of the economy. Okay. She's very willing to keep rates as low as they need to be to keep the economy going for as long as possible, and even more than Chair Powell. So she's been one of the most dovish on the Federal Reserve. Now, what happened is last week she came out with a speech where she was very much more hawkish. She was talking about how rates do need to come up, and that's when you say somebody is hawkish, that means they are raising rates. They are pulling back, the stimulus on the economy from the Federal Reserve, from that monetary policy, right? So she was talking about how rates need to come up aggressively, come up very fast to fight inflation. She was talking about how quickly the Fed needs to reduce its balance sheet, so pull back some of the stimulus it's pushed into the economy over the last 2 years, and we actually did get a number on this last week. Let's look at. So we had the Fed minutes last week, along with the comments by Vice Chair Brainerd, and the Fed said that they would probably start shrinking the balance sheet by $95 billion a month. So what y'all got to understand here, folks, is that, and I can even show you, I can show you here if we look in another really great source for data that I always use. Go to the Federal Reserve. It's the St. Louis Fed, Fred, it's a fred.stlouisfed.org, right? If you just type in Google, type in Fred or type in Federal Reserve Fred data, and you can find all this data collected by the Federal Reserve. Some really great stuff. We'll type in Fed balance sheet here, give you an idea of what I'm talking about, because this is very important as far as what it means for the economy. So this is the Federal Reserve balance sheet. This is the bonds that the Fed has bought and the Fed holds on its balance sheet when the Federal Reserve, besides just changing its interest rate policy and changing interest rates, it can also buy bonds. Okay, it can buy mortgage bonds, it can buy treasury bonds, and what it does, obviously, when it buys those, then it pays cash for them, right? It pays cash, it pushes cash out into the economy, and that's one way that it stimulates the economy. One way that it drives economic growth is it buys all these bonds. And what you can see here is what it's done over the past, this is a chart going back to 2004, and you can see this big bump during the recession of 2008. It bought, about 2.1, it bought about a little over $1 trillion, about $1.3 trillion in bonds, really pushing that money out in the economy and stimulating the economy. Continued to do that all the way into 2014, 2017, where and then in 2019 it actually started letting some of that come off. It was down to about 3.7 trillion on its balance sheet. So the value of the bonds on the Fed's balance sheet was about 3.7 trillion. Then look what happened. 3.7 trillion all the way right now up to $9 trillion. So in that space, we're saying in that space of time from 2019 through the pandemic, it bought more than $5 trillion worth of bonds. It pushed $5 trillion out into the economy. Okay, that is obviously, looking at this chart, obviously unprecedented. No other time in history have we seen that much economic stimulus, monetary stimulus pushed into the economy. And, you see it in any stock chart you look at. Any stock chart where stocks just boomed over the last few years, because you had all this money, not just from the Fed, but from the federal government as well, just being pushed out in the economy. It had nowhere to go. People weren't really spending it quite as much. So it just went into stocks. It went into asset prices and pushed those up, and this is really the effect. Now, what happens? Now, like what we saw from 2017 down to 2019, where the Fed is saying, okay, look, inflation is getting very hot. Inflation is getting heavy. We want to slow down the economy a little bit to keep those prices stable, keep inflation lower. So what we're going to do is, as those bonds mature, as those bonds get paid off, we're not going to reinvest that money. We're going to let that money drop off of our balance sheet. And again, what they said last week in the Fed meeting minutes is they're going to do that at a pace of almost $100 billion a month, which again is unprecedented. We've never seen the Fed letting that much money drop off its balance sheet all at once. So what's important here when you think about where the economy is going, why the economy is, why the economy and stocks might be falling is because the old saying used to be, don't fight the Fed, right? As the Fed is lowering rates and stimulating the economy, pushing all this money out in the economy, stocks are going to go up because it's just the power of the Federal Reserve, the power of the central bank. Well, it works in reverse too. As the Fed is increasing interest rates, as they're pulling back on their stimulus, and letting their balance sheet shrink, then that's going to be a very hard turn for the economy and eventually and for the stock market. And that's really what we're seeing right now. So that's just kind of an idea of why stocks are selling off and what they're doing. What to watch this week? Stock earnings, first quarter earnings are coming this week for the banks. The banks are starting us off on first quarter earnings. Might be something that kind of helps support the market if earnings come out very well. Now, analysts expect earnings to only be about 4.5%. Year over year for S&P 500 companies, which is extremely low. We've had about 6 straight quarters of 20% plus growth in earnings. So an estimate for 4.5% is extremely low. I think it's too low. Obviously, companies will have no problem beating those earnings expectations. Of course, what we've seen over the last couple of weeks with a lot of companies is it's not really what they report, it's what they say about the rest of the year. Okay, it's their outlook, their guidance for 2022, how much they're talking about inflation and how much that's going to hurt earnings, things like that have really caused a lot of stocks to fall by 10 and 20% on their earnings day. So we'll have to watch for that. I think there's obviously some stocks, some sectors that'll do better than others. Bank stocks really starting to report this week, and we'll talk about some of those stocks. But bank stocks are estimated to fall 36% on their, the earnings that they report are estimated to be down 36%. And really a lot of that reason is they're now starting to put money aside just in case the economy does go into a recession and we get those higher loan defaults. And it's very interesting because this is kind of the same thing that they went into the pandemic doing, is moving that money into a what if account. And it ended up being some of the best returns that we saw in bank stocks, over the year to that, over last year. So we'll be watching that. The outlook, hasn't been too bad for consumer staples. I think, as those start to report earnings, I think those are going to continue to do well, because we've already seen the sell-off in a lot of those stocks due to inflation. Again, healthcare is doing well. What I really want you to watch this week, one of the most important data this week is tomorrow's consumer price index. Okay, the CPI, that's the inflation, the main monthly inflation report we get each month, comes out tomorrow. Usually comes out on the 12th or on the week of the 12th. And tomorrow is going to be ugly. Tomorrow's consumer price index is expected to be 8.5%. So that's 8.5% inflation over the last year. It was 7.9% last month, so inflation is only getting worse. And I think it could actually be worse than that 8.5%. Okay. We saw such a huge rise in gasoline prices. The grain prices and agricultural commodity prices won't quite be in that number yet because they haven't flowed down through the consumer yet. But we're going to start seeing those over the next few months. But really, that huge surge in inflation last month that we saw, I think that's really going to drive this up, and it could be even higher than 8.5%. So that could be another very negative shock for stocks. Just how bad that inflation rate is going to be. We're already looking at 0.5% rate hikes by the Fed over the next few meetings. That's pretty much priced into stocks, though, and this is just going to guarantee it. The 10-year Treasury, so rates are going to continue higher, on that higher inflation. This is a three-day holiday for the market, so the market is closed on Friday for Good Friday. Let's hope it's a good week, but it doesn't necessarily look like it. A lot of times, especially into these 3-day weekends for the stock market, investors and those big money managers, they get to Thursday and they say, a lot could happen over the weekend. We got a 3-day weekend and a lot of bad news could come down. I don't want to be long on stocks. I want to cover my positions on Thursday. I want to just sell out and wait for the next week and not take that risk over that long weekend. So typically what we've had in these holiday shortened weekends is we've had a little bit lower markets. So we'll see if that happens and see if people start selling in. I mean, it could happen on Tuesday with that CPI report. It could happen as early as Wednesday or Thursday. But I think the impetus is lower for the week. I want to look at some stocks to watch this week because it is a heavy earnings week. Like I said, first quarter earnings are coming out. CarMax is going to report its earnings tomorrow on Tuesday. It's going to be interesting to see if that combination of higher car prices over the last year and the recent rise in rates is really going to hit demand for cars, like we've seen it hit demand for housing, right? We got mortgage data over the last couple of weeks. The first mortgages or mortgages to buy a house are down like 9% over the last year. Refinancing is down like 60% for refinancing a home. Those mortgages. So those higher interest rates really starting to hit the real estate, the housing market, and I think probably starting to show on the car market as well. So it would be interesting, to see CarMax, see what they say, especially about the rest of the year. These shares are already down 34% from that November high, so they've already sold off quite a bit. So, I wouldn't be expecting a huge drop on any bad news, but it is evident that, car prices have just boomed, just like housing prices over the last year, and the interest rates aren't making things more affordable. Okay, so interest rates, that combination of interest rates and higher prices, really going to hit the car market just as it's hitting the housing market. So it'll be interesting what CarMax says about that. JP Morgan starts us off really with the first quarter earnings, reporting earnings on Wednesday. I think actually, like I said, I think the banks could have a surprise upside, especially on trading revenue. So again, what you have to understand about bank stocks is there's really two different types of banks. One is a capital markets bank. One is a bank that deals a lot with, investing and trading and investment banking and bond sales and things like that. Those are your banks like JP Morgan, like Goldman Sachs and Credit Suisse. Those banks that have more capital market or stock market exposure than your typical regional or smaller or commercial, lending banks. Those lending banks like Wells Fargo, like a little bit more Bank of America and Regions Financial, those commercial banks or those regional banks, those are the banks that have most of their revenue, most of their money coming from lending. Okay, so what you got to understand here is, when you get upsides in trading revenue, like we've seen over the past month, a lot of these capital market banks had some pretty good trading revenue in terms of trading inflation hedges, inflation and interest rate hedges. They made some pretty good money, so we could see that come out, in the reports for companies like JP Morgan. Goldman Sachs is reporting on Thursday. They could report something like that as well. So I think there's a potential for some upside surprise in some of those. We've also got Bed Bath & Beyond reporting this week. It's going to be interesting. The company, the shares here are down 30% from this spike. We had this big spike in late March for Bed Bath & Beyond. Obviously, the chairman of GameStop, Ryan Cohen, activist investor, had taken a huge stock step in the company, a huge percentage of shares in Bed Bath & Beyond, saying he wanted to see some shareholder value unlocked. He didn't feel management was doing a good job of managing their turnaround, and really pointed to a lot of value in specifically the Bye Bye Baby part of this company, the Bye Bye Baby segment of Bed Bath & Beyond, and said that they should even think about maybe splitting the company up, splitting off that Bye Bye Baby segment into its own company, really to unlock that shareholder value. So it's interesting that the shares jumped so much there in March on that news, on that positive news that Cohen was taking a stake and going to be trying to force the company to turn around. It's interesting that it has come down so much so fast, 30%. I expect the company is either going to name Ryan Cohen to the board of directors or announce some other strategic decisions on this earnings report or this week. They've obviously got to do something. Cohen isn't going to go away. These activist investors, they typically don't just back down unless they're like Carl Icahn and they take a green mail payoff to sell their shares. But typically, a lot of these activist investors, they're in it and they're really going to push for changes in that stock. So unless he's sold out of his shares since he reported in March, which I highly doubt that he did, because I mean, that would be a kind of a dramatic turnaround for an activist investor to sell out within less than a month of reporting that stake. Then they're going to have to address it. They're going to have to address it in that earnings announcement. So again, I expect they'll either name him to the board of directors, which would be positive. It would put an activist investor on the board of directors and really a path forward for the company, or they're going to announce some other strategic decision to kind of appease him, and that could boost the shares as well. So I own shares of Bed Bath & Beyond. I think they could get some positive news this week. Delta Airlines, really the first airline stock, is going to report earnings. Going to report earnings on Wednesday. And while travel demand has been pretty strong over the first quarter, we've got that surge in jet fuel costs. So it's going to be interesting to see what they say about that. The potential for an economic slowdown and interest rates won't help the travel industry or this industry. So I think Delta, it's going to be it's going to be touch and go what they say, especially about the rest of the year. I think obviously they're going to come out and say they're going to say that as long as this war, as long as the invasion of Ukraine lasts, the worse it's going to get, because the higher oil prices and fuel prices are going to be, and that's probably going to hit the bottom line. So I would think about maybe hedging my position in Delta or some of these other airlines, going into that. If they do say that, hey, these fuel prices are just too much, it's eating into our profits, and we're looking at a more negative rest of the year. Last one here, Goldman Sachs continues bank earnings, going to come out on Thursday with its earnings. Again, I think there is some potential upside for surprise on trading revenues here. What's interesting about Goldman Sachs, though, is it is selling so cheaply. The stock, Goldman Sachs, is right now trading for about 1.1 times book value. Okay, and book value is really, price to book value is really the measure you want to use for bank stocks. Okay, it's really a spread bet. The difference in interest rates between what they pay on their deposits and what they collect on those loans, that's really the spread, the profit they're making on their business, and they report all that on their balance sheet as book value. So that's really a great indication. That price to book is really the indication you want to look at as far as valuation for these stocks. A valuation of 1.1 times book value is very low, especially for Goldman Sachs. Goldman Sachs usually trades, over the last 5 years, has traded for an average of 2.6 times book value. Okay, and now it's down to 1.1, so it is less than half of what it's traded, as far as per book value over the past. Any positive news here on Thursday from the bank, I think could get some of that value out for investors. So I would definitely be looking for that. Want to look at so we had some big news in the crypto space last week. Obviously, cryptocurrency had the Bitcoin 2022 conference there in Miami. A lot of news out of that for Bitcoin investors and crypto investors. One of the most interesting one was Peter Thiel. Okay, Peter Thiel was the first outside investor in Facebook. He is the Justin Timberlake of the movie, right? He's the co-founder of PayPal, the co-founder of Palantir. So a very smart tech guy, very much a smart investor. Called Warren Buffett a sociopathic grandpa from Omaha. He also said he's enemy number one for Bitcoin. He also called out a lot of these bank presidents, Jamie Dimon from JP Morgan. He also, Larry Fink, which is a CEO of BlackRock. He called them out as enemies of Bitcoin, enemies of cryptocurrency. So, obviously the gloves are off for, between the naysayers and the deniers, the naysayers of crypto, and the believers, the investors, which, some of this is obviously, I can understand JP Morgan and Larry Fink and the bank presidents, the other bankers, coming out against Bitcoin and cryptocurrency. Obviously, it is very much a threat to their way of doing business. If you can move money seamlessly and at a very, very low cost with cryptocurrencies, you don't need your bank. You don't need that middleman or the fee taker in a lot of those financial transactions. So it would make sense that a lot of the bankers and the bank presidents say that Bitcoin is a fraud or worthless or that kind of thing. You also get, Peter Thiel talked about a crypto gerontocracy, or what was the word? He's something, financial gerontocracy, right? So basically these old guys, especially 70, 80-year-olds like Warren Buffett talking about cryptocurrency, really that they don't know what they mean. And I can kind of understand the frustration, right? I was a long time bear for cryptocurrency, a long time, a denier of cryptocurrency, really until I took the time to research into what the value is in the blockchain, in Bitcoin, in cryptocurrency, and really came to the idea that, yeah, there is some very good intrinsic value, very long-term intrinsic value in these. So what Thiel is saying is that, this gerontocracy, these old school, old timers, they're just like old grandpas sitting on the porch that are saying, you know what? No, I don't know about it. I don't understand it, and I'm not gonna give it a chance. So very frustrating, obviously, for Bitcoin investors when those people come out. But interesting that he would take it to this length of calling Warren Buffett a sociopathic grandpa, which is funny, to say the least. So a couple other things, I want to get to kind of that main topic that we're talking about here today. How to protect your money, where stocks are going. Like I said, the stock market does look to be opening lower today. It's big sell-off last week. Nasdaq's down something like 15%, since the November peaks. So people are asking, what should I do? How to protect my money, or should I even protect my money? Where are stocks going, right? And again, I think there's really two things you need to think about here, and different strategies you can use depending on what kind of investor you are, and kind of using some of those clues or cues or tips from the investing experts in that blog post on how to protect your money. So one thing I want to talk about is, there is no doubt in my mind we will have a recession. Okay, we will. The Fed has never been at something like this point where they needed to take $5 trillion out of the economy, shrink their balance sheet by $5 trillion. And inflation is at 40-year highs, so they have to be aggressive at raising rates. And historically, the Fed has never been very good at managing this. Managing how much it raises interest rates, not to kill the economy. It has typically been a very bad manager of that process, and typically sends the economy into a recession eventually on that. And it's just so extreme right now that I don't see how they can do that soft landing. Okay, you're going to hear about the difference between a soft landing and a hard landing with the Federal Reserve, with their interest rates. Okay, a soft landing is when they bring the economy down just enough to lower inflation, but they still keep unemployment low as well. They still keep a good jobs picture, good employment, and so it's kind of a soft landing for the economy, right? Now, in comparison, a hard landing, which is more often than not what we've gotten when the Fed when the Fed raised interest rates, is just a crashing recession, right? It's a hard landing. They bring the economy down hard, right? It brings inflation down, yes, but it also hits the jobs picture because it sends the economy into a recession. Obviously, you get a stock market sell-off, a stock market crash in that instance. There is no doubt in my mind that we are going to get something like that. The problem is timing here. You hear everybody scream bloody murder about the economy, about the Fed and interest rates and things like that, but they never, a lot of banks are coming out with their calls for a recession in 2023. So a recession next year. But the problem is being early to a lot of this stuff is just as bad as being wrong sometimes. If you're selling out of your stocks right now, and we get another 15% or 20% upside in stocks before the recession actually hits, and before stocks actually sell off on the recession, then where are you then? What happens a lot of times, and this is the worst part. This is the tragedy. The tragic part is that a lot of times investors will see the stock prices coming down. They'll sell out of stocks because they think a recession is coming, and they think stocks are going to fall further. And what happens? Stocks go up another 15%. Well, over those 6 or 7 or 9 months that stocks go up, they're like, well, shit, I just made the wrong decision. I'm losing money by not being back in the stock market. So stocks go up 15% and they put their money back in. So now, not only have they lost that opportunity for that 15%, but now they're right at the point where stocks are going to start crashing, where stocks are going to come down because of that recession. Okay, I want to show you one graph here that is actually it's going to be in a video coming out pretty soon. This is the historical returns after interest rate hikes, while the Fed is increasing rates. Okay, so this is what we're talking about right now. The Fed is increasing its interest rates, is pulling back on that stimulus from the economy. And everybody's crying bloody murder. Everybody's crying. The sky is falling. Stocks are falling. Stocks are going to be in a crash. But look at what's happened. Look at what happened over the last 3 times that the Fed has increased interest rates. Okay, and you look here at the average, stocks, almost every asset class has been higher. Okay, so you've got even bonds, which is weird because bonds are supposed to fall, right? Supposed to fall when interest rates increase. But you had other than high yield bonds in the 99 to 2000 period, you had bonds going up all three of those other periods, right? You had stocks. You had large cap value stocks up 7%, large cap stocks up 10%. Real estate stocks up 11%, gold up 12%, the growth stocks even up 14%. And in global commodities surged by 26% on average over those last 3 times that the Fed was increasing interest rates. So that kind of defies the odds, the expectations that as the Fed raises rates, then eventually we're going to get a recession and stocks are going to fall. The thing here is that, it's that timing. Okay, the Fed is raising interest rates because the economy is so strong, and the economy is strong. Consumers are still spending. They've still got a lot of money, lower credit. The consumers, a lot of people, households paid off their credit cards during the pandemic with all that stimulus money, right? So they've got, they've got room to spend, room to borrow. Interest rates are still very low compared to history. Interest rates are still near zero. So the economy is strong, and that should help boost stocks, or at least support stocks from here. So what I think happens is what we talked about is that what we see in this data, that as the Fed raises rates, it's not a death knell for stocks. Yes, I know it hurts. It sucks to see stocks falling by 2 or 3% a week. You see that initial reaction, and that's what we're seeing here, is that initial reaction of people that are seeing, okay, you know what, the recession may be coming next year. I want to get out of stocks now. That's the big knee-jerk reaction that we're seeing right now. Those are the people that are selling their stocks, panicking, getting out of their markets, and those are going to be the people that in 6 or 9 months are saying, well, shit, I made exactly the wrong decision. I got to get back in stocks now because stocks are going higher, because stocks are rebounding, and that's going to be the worst time they're going to do it, right? Because at that point, we will start to see the economy starting to crack a little bit. We will start to see, stocks coming down back again, off of those recession fears. So I don't want you to panic. I don't want you to sell out of all of your stocks right now just because we might get a recession next year. Okay. Now, some things that there are some things that you can do though, to kind of protect your money, to help protect some of your money, kind of lessen the pain, if the stock sell-off continues, or whether, how long it takes for the stocks to start rebounding. One is you just need to hold other assets like real estate and like bonds. It is very crazy. It's crazy to say that, and a lot of people are going to say you're stupid, you're an idiot, you're an asshole, whatever. You call me whatever you want. I've heard worse. But there are going to be people who say you're an idiot for buying bonds at this point. Well, look, because things like the bond index, the BLV. Let's look here at the BLV. This is the Vanguard long-term bond index. It's down like 15%, over the last couple of months, which is, again, for that kind of a move in a bond index or in a bond fund, is unheard of. Down more than 15%. 86, it's down about 20% since November, which is just a crazy move for a bond fund. Bond funds are supposed to be very safe, very stable. They don't rise and fall by 20% just any old day. So to be down by 20% is huge. A lot of people have abandoned this fund, and I think right now is probably pretty close to the time to start buying. It is now producing, or is now creating a 2.9% yield. Okay, and these are long-term bonds. So it is now paying 2.9% dividend rate. It is going to be, it's going to get back up to that 100 eventually, within the next year or so. So that is a 15% return or 20% return on your money. Even if it takes years to do that, that is a safe and stable 4 to 5% return on your money. Right, it's going to protect your money from a stock market crash. If you look at a chart here of what this stock did, over the last 10 years during the recessions, we can compare this to, say, the NASDAQ. Let's do 5 years. Okay, so you can see here in the during the pandemic, the Nasdaq lost about 40%, 45%, right, on the Nasdaq. This bond fund, kept on rising. It had a little bit of a blip here in the right during the pandemic, but it just pretty much rose all the way through it. If we looked back in the other periods, 2008, things like that, it's very consistent. It never sells off by that much, and then it rebounds, because of those interest rate stories. So what I'm saying here is just have a little bit more money in some of your real estate investment trusts, your real estate stocks. In those, you've got stocks like Stag Industrial doing very well right now. You've got some of your data center stocks, so your data center real estate investment trust, stocks. You've got some of your other real estate stocks. Put some money into some of those, some money in some of these bond funds. Maybe not the BLV if you don't want to, but the BSV, which is the Vanguard short-term bond fund. It's not going to fall as much when rates hit. I think the BSV, so compared to that BLV, which is the long-term bond fund, that one's down 20%. I think the BSV is only down maybe 6%, right? So it's not going to fall quite as much when interest rates do rise, but it's still going to protect your money. It's still going to give you that protection against a stock market crash. And again, what's interesting here is I do think interest rates are going to continue rising. I think that's going to continue to limit the returns on these bond funds, on those bonds. But you get to a point, where when the interest rate on the 10-year Treasury gets up to 3% or 3.5%, you get to a point where these bond funds are just too good to pass up. These bond funds at that point at 3% or 3.5% on the 10-year Treasury, these bond funds are going to be providing, a 3 and a 3.5 and a 4% dividend yield. Plus that protection you need. So they are going to be great protection and great income stocks. I think you really start looking back into those. I think again, a lot of here is important in understanding your time horizon, your risk tolerance. If you are someone that really gets worried, that looks at their investments every day and gets emotionally worried and distressed whenever you see your stocks go down, then yeah, you need to protect yourself right now, and then you need to have the guts, the intestinal fortitude to when stocks do go up, say, hey, that's all right. I wanted to protect myself. I can take, not participating a little bit on that upside just for some more protection, just for, I wanted to buy more bonds. I wanted to diversify my assets, things like that. So it's okay if I don't get the very peak of the market, if I don't participate in that rebound quite as much, if I did protect myself then and not have to worry about stocks every day. Okay. If you are somebody that can take a little bit more risk, you got a longer time horizon, 10, 20, 30 years until retirement, then, you can stay in some of those stocks. You take advantage of these stock prices that are going down. Again, the best time to buy stocks as stock prices are coming down, because eventually that stock prices are going to go back up and you're going to have gotten the best deals. Okay, so just don't freak out, as stocks start coming down. I do think we get better prices later on in the year. I think, after this initial knee-jerk reaction that everybody has, selling out of their stocks. Oh no, a recession is coming eventually. A recession is coming next year. People selling out of their stocks now. After we get that initial sell-off, that initial knee-jerk reaction, we do get stocks rallying into the summer and into the fall, before maybe a worse sell-off, later this year and early next year because of that recession. As people actually do start getting closer to that recession, the economy actually starts cooling down and slowing down. That's when you really need to worry about your stocks, protecting your money, because that's when that bigger crash actually does start to happen. So I want to turn it over to the chats here to answer some of your questions. Love this part of the live stream, just being able to talk back and forth with you. I did see a super chat earlier. Connor Clancy, I hope you're still on. Thank you for that 10 euro super chat. I appreciate that. Didn't get a chance to look at it when it came through. So he says Armor REIT pays a 14% dividend. It's not a month. That's a year. That's a yearly dividend. You're getting your money back after 6 months. And is this too good to be true? Okay. So what he's talking about here, a couple things here. Armor REIT. Okay. So let's look at Armor REIT. And I can tell you, it is, the way you're looking at it, it is too good to be true, because it's not really doing that. This is the Armor Residential REIT. Okay. And I believe this is a mortgage REIT. Right, they invest in mortgages. I want to make sure here, because I think it's an M REIT, right? So a mortgage company. Yep, it's a mortgage REIT. Okay, so just wanted to make sure it was the type of REIT, because there's really two types of REITs here, folks. One is this mortgage REIT. What they're doing here is they're borrowing on short-term rates, right? They're borrowing on those, 3-month, 2-year short-term rates, paying very little on those rates because those rates are still very low. And they're leveraging that up. They're using that money that they borrowed, leveraging it up 3, 4, 5 times to buy 5 times that amount in long-term mortgages, right? So they're really getting that spread, that leverage spread between short-term rates and long-term rates. And of course, since it's a REIT, a real estate investment trust, it's sending most of its cash flow through to investors. So that spread, that leverage spread that it's receiving, it's sending that back out to investors through a dividend. And that's why you see something like this 15% dividend on this stock. Now, first of all, what's important here, and this is a monthly payer, so this is going to pay out its dividends every month. What's important here is this is not 14% a month. Okay, this is 14% a year. Dividends are always quoted, dividend yields are always quoted in an annual amount, okay, an annual percentage, right? So what it's saying is you're making 15% on the stock price, 15% dividend each year. Okay, so you divide that by 12 to find, how much it's paying. It says it's paying $1.20 a year, so $1.20 divided by 815, you get that 14.7%. Now that's per year though, so it's probably paying about 10 cents per month, right? If you take that $1.20 it's paying a year, divide by 12, that's what you're getting every month on those shares. So you're getting 10 cents a share in dividends every month. Currently, what that residential real estate or that mortgage REIT is paying right now. So one thing to consider there, it's not every month, it's 1 year. So it's going to take you a little bit longer. Now, what's important about these MREITs is to understand, how interest rates affect it, how a recession affects it, how just the mortgage market affects it. We're seeing a big slowdown in the mortgage market. So it might start getting harder for this company to find those mortgages to invest in or the kind of rates that they're getting. Okay. I can tell you that mortgage REITs tend to do worse than any other industry or any other sector when inflation gets really bad. When inflation gets bad and we look like we're heading into a recession. So I wouldn't get, like a lot of these stocks that pay a super high dividend yield, do not just chase that yield. Okay. You have to look at total return. You have to look at what's coming in the economy. I like these. I like MREITs. They're those high dividend names. They are going to put cash in your pocket, but the returns are typically less than this dividend yield. The returns are typically still going to be 8 to 10% total return because the stock price is going to fall. So if you go out here, if you just look at a chart, you just look at a chart and the stock price has fallen from $26, over the last 5 years down to $8 right now. And you say, why does that matter? If I'm going to hold the stock, I don't care what the stock price does. I only care about the money they're giving me through that dividend. Well, the problem here is that, folks, that, as that stock price falls, eventually they do end up cutting the dividend. They end up cutting the dividend, and so you don't receive quite the dividend yield that you thought you were going to when you bought the stock at $26 each, right? You're still going to get a high dividend yield, on that current stock price, but the current stock price has now come down to $8, right? So I would bet if you looked at the dividends they were paying it when the stock was at $26, it was much higher, much, much higher than it is now, that 10 cents they're paying every month. So, it can still be a good stock. They're heading into harder economic times right now with inflation and interest rates, which, of course, is a lot of the reason why the stock has come down since April of last year. Has come down quite a bit, come down from $12. So come down about 30% since April, as we started to see inflation come up and really hitting that MREIT industry. So it's got to be a part of your very long-term portfolio. Otherwise you're going to get worried about this falling stock price and things like that. But great question there, as far as what are MREITs and how is that too good to be true? And yes, honestly, obviously, it is too good to be true for some of these stocks that pay those 15 and 20% dividend yields. You really got to understand, okay, where is the dividend going? Am I always going to get that dividend yield? Where's the stock going? How does the economy affect this stock? Things like that. I'm going to scroll through here, see what else we've got as far as comments. Again, love seeing everybody here from the Bowtie Nation, from everywhere. Some people from Switzerland, Japan. It's cool to see everybody from all over the world. Really kind of a connected global community here on the channel. So that's pretty cool. Kenny Scott asked earlier, is it time to buy energy stocks? Again, kind of talked about that. I wouldn't be buying energy stocks at this point. I wouldn't be jumping into them because they're obviously very high, already because of those oil prices. If I own energy stocks, which, okay, obviously I do own energy stocks. I own Chevron, I own Diamondback, some of those others. So if you own energy stocks, I'd keep them. I'd maybe hedge with selling some covered calls against those, just so you can keep the stock, you keep the dividend coming, but you maybe lower your risk a little bit because, obviously I think it's obvious energy prices are going to come down. They can't be $95 a barrel if we're looking at a recession and looking at a slowdown. Obviously, energy prices, oil prices are way too high right now. So those will come down, and that's going to marginally hurt some of these energy companies, but they're still going to be making lots of money. So I would hold on to them. Wouldn't necessarily buy a lot more of energy stocks right just yet, though. So Will asks, notice when you do covered calls, usually do them with about a year until expiration. Why do you prefer that over something like 30 to 60 days? Great question, Will. Will's talking about some of the videos where I talk about doing those covered calls. Then what I do is I usually pick the January of next year calls, right? And a lot of times even further, a year out at least on those covered calls that I can do. And there's a couple of reasons for this. One, because a lot of people do like picking 1 month out or 2 months out on their calls to sell. And being able to do that every couple of months, being able to sell more call options against their stocks and collect more money. The reason why I do longer term calls, one, I don't have to worry about it. I just lock in that covered call over the next year. I get a lot more premium. Okay, so I make I make a lot more money on my covered calls than somebody that's going to do it for 1 month. Okay, now of course if you can do it for every single month, you're going to make more money that way. But by selling the 1 year ones, the 1 year covered call options against the stock I own, I don't have to worry about it. I collect a big upfront check right there, from that covered call option. But more importantly, though, for taxes, if I can sell a covered call, if I can sell a call option that has more than a year to expiration, then that is going to be and I let it go to that expiration. That's going to be a long-term capital gain, right? That's going to be a long-term capital gain rather than short-term gain that I have to add to my income. Okay, so very important. If you're in the higher tax bracket, then you really got to watch those short-term gains. Okay, so if you're selling a call every month, that's going to be a short-term capital gain. You're going to add that money to your income for your income taxes, and you could be paying quite a bit of those profits through to taxes to the government, so which nobody likes to do with that. So that's one of the probably the biggest reason that I use why I pick those longer term options to plan to sell. Great question though. I love that question. Is it a good time to buy bond ETF for my IRA? Should I wait till later this year? Okay, great question again. Cross Creek, something I kind of talked about here earlier. Bonds are looking very good right now. Some of these bonds, like we looked at that BLV, that Vanguard long-term bond fund, ticker BLV, paying 2.9% dividend right now. And you're looking at a pretty good return over the long term as it comes back up to those prior levels. So I don't think you can be worried about buying it now. If you are that risk averse investor, if you're somebody that's going to need their money within the next 5-10 years, if you're somebody that gets freaked out and just gets emotionally stressed, and when I say freaked out, that's not necessarily a bad thing. Okay, they understand there's a lot of people that just get emotionally worried, emotionally distressed, and give themselves ulcers about watching their stocks every day and watching those stock prices come down every day. If you're one of these people, there's nothing wrong with just going for safety. There's nothing wrong with protecting yourself, not having to worry about it. Do what you do best, folks. Make money how you make money. Don't worry about stocks. Okay, so protect your money if you want. Get in those bond funds, and you're gonna make a good return on those. Now, what I would say for somebody that can handle a little bit more stress, a little bit more risk in their portfolio, I think you probably do get a little bit better returns by waiting a little bit. Again, I think we get some kind of a rebound in stocks over the next 3 to 6 months, and I think the interest rates keep going up, so it's going to hurt those bond funds just slightly, and those yields on the bond funds are going to go up. So I think within the next 3 to 6 months, then that's when you start looking at these bond funds and you see the yield on that BLV, you see that go up to 3.5%. So 3.5% dividend yield on a bond fund would be amazing. It would be you get that protection, plus you get a very good income yield on that. That's when I really would start putting more money towards the protection and putting more money in the bonds and things like that. Okay. What else? Rick Sawyer says, I love seeing my target stocks falling to 1990s prices. Now that would be tough though. That'd be tough. I mean, I do love it when stocks come down and start giving me better prices, but 1990 levels would be tough on some stocks. But good, good to see you here too, Kitty. What else? So what do we know about? Some individual stock questions. NNDM, don't really know that one. NEO, I know NEO has had to pull back a lot of the Chinese stocks, the stocks dependent on Chinese economy. A lot of those have pulled back because of the COVID lockdowns. Okay, China is seeing a resurgence of a new type of COVID, a new variant there. They are being very aggressive on their lockdown, so that's going to be slowing down the economy. The thing is about a lot of these Chinese stocks, and not necessarily NEO. I don't know, haven't quite looked at that, but I'm talking about shares like Alibaba that I own, some of these other companies, these other Chinese stocks that I've just recently started buying here in this last month. Compared to the U.S., compared to Europe, which are raising rates, are slowing down the economy, China, the Chinese government is very much aggressively pushing the economy. They are very much, lowering interest rates, stimulating the economy because they've had the weakness over the past year in the real estate sector and other parts of the economy. So, they are, whereas we are slowing the economy here in the U.S., in the Europe, the Chinese government, they are pushing on the economy. I think that's going to help their stock market, help stocks. They have an election coming up this year, and obviously, since it's a communist party, they pretty much control the government and all that. It's not necessarily democratic, right? They still care about, what people think, investors at the polling stations, things like that. So they are going to be stimulating the economy. They're going to help push the economy and push stocks. So, I wouldn't be quite as worried about some of those Chinese stocks. I think they've been beaten down too hard. Again, I own shares of Alibaba. I own shares of Tencent. And some of those stocks that have sold off so much over the last 6 months. Melanie Struck, good to see you here. Melanie's a long-time citizen of the Bowtie Nation. She's one of the founding members of the Bowtie Nation. So great to see you here in the live stream, Melanie. What else? What do you think? Claudio wants to know, what do you think about SoFi? I've got a video on SoFi. Actually, check out. Not last week, I think the week before, I did a video. It's the top 7 stocks in my portfolio, the 7 stocks I have the most money in, $250,000 across these 7 stocks, and SoFi is one of them. SoFi is actually one of my favorite growth stocks right now. And actually talking to some friends last night in a group, talking about the difference in those 7 stocks that I talked about. The difference in the shorter term value plays and the longer term growth plays. Okay, so there's some stocks in there that I have like Groupon, like Weight Watchers, that I think are just so attractive on a valuation basis, are so cheap right now. They're just hard to pass up. They're hard to deny the value in those stocks that I think could turn around within the next year or two. So I own those. Then you've got other stocks like PayPal, like SoFi, like Teladoc, where the next year could still be tough. We've got the Fed raising rates, we've got them pulling back on the economy. That's going to hurt a lot of these growth stocks. Could still be a tough market for some of those growth stocks, for some of those tech stocks. But the long-term picture, that growth picture is still amazing for some of these companies, especially SoFi. SoFi is one of the only fintech companies, the only bank, online banks, financial technology companies that actually has a bank license. That traditional bank license. What this does for them, it allows them, compared to some of your other online banks, some of your other, I don't want to say online banks because they're not banks. They don't have that license. Some of their other online financial companies, they don't have that bank license. They can't provide like savings products, checking accounts, different kinds of traditional banking products. They can't do that because they don't have a license. SoFi has that. So SoFi is going to be growing so much stronger, as we shift to digital banking, as everybody shifts to digital banking. SoFi is really the bank of the future. And I think this could be one of those big mega cap banks, over the next 10 years. So I really do like SoFi. I actually bought more stock, more shares here in this last week. The thing you got to understand about SoFi is, and especially the sell-off last week, is because of the student loan moratorium. Okay. And I know, folks, I know it's great to think, hey, I don't have to pay off my student loans right now. I can just wait to make those payments, all that kind of thing. And if you got student loans like I do, then hey, I mean, I'm waiting forever to pay them off. But there's no need to. I mean, come on. Unemployment is down to decade lows. Okay, with unemployment rate at 3.5, 3.4%, 3.6%, I think. Wages are going up, wage growth is going up. There's no reason why people shouldn't be paying off their student loans. And you call me an asshole, you call me an idiot, say I don't know what's up, all that kind of thing. But with the economy this strong, why are we not paying back our student loans? Why are we not paying back the debts that we took out, when we took them out, right? Now, that's not to say some of these for-profit schools that just really rip people off and, shitty degrees, things like that. Those, just forgive those, wipe those debts out. But, if you went to a good school, a regular school and got those student loans, hey, that was the money you borrowed. Pay it back, right? Anyway, get off my soapbox here. And what you got to understand, though, is that people haven't had to pay off those student loans for like 2 years, through the pandemic. And that was fine during the pandemic. People were out of work or not going to work and things like that, and people needed help. But, they've been extending this moratorium, this forbearance on student loans for years. President Biden did it again last week. He said, okay, you know what? I don't want the elections to go bad, so I'm going to push off this student loans again until August 31st. Of course, because it's an election year, it's going to be pushed off again, probably through next year. And with SoFi, you got to understand they started as a student loan refinancing company. They've since extended into all this other financial banking and stuff, but they still do have a lot of business in student loans. So, obviously that moratorium has hit their bottom line. The management said, okay, you know what, we're going to pull back on our guidance this year because we don't know when people are going to start paying back their student loans, so we really can't give you a picture on that. So that did hit the shares last week. But again, with these growth stocks, these long-term growth stocks, especially SoFi, this is a great long-term story. Eventually, people are going to have to start paying back their student loans, and that is going to be a big boost, a big short-term boost for SoFi, and then you've got the long-term growth still ahead. So definitely, definitely be looking at that. What else? Family's money stocks. Okay, just scrolling through, looking for some more questions. If I don't see your question, make sure you use a question mark on it so I know that it's a question and can see that pretty easily. How was your weekend? Thoughts of HP and Buffett? Okay, so Danny called me Rich Dad. I don't know how that works. I'm not taking any paternity tests to be your rich dad, but that's okay. So Danny, good to see you though. How was your weekend? My weekend was pretty good actually. Worked. My weekend is basically, I get to Friday and it's all right. 2 more work days until Monday, right? I work 7 days a week, a little bit less on Sundays, but I love doing this stuff. I love looking at the markets. I love bringing that information to you in the markets. I love doing the newsletter that we put out, things like that. So, I'm here in the office. Which just happens to be my home too, so that's always a bonus. And doing this 3 or 4 hours at least every day, usually closer to 8 or 10 hours. But anyway, what are your thoughts on HP and Buffett? Should we invest on the HP stock itself or Berkshire? Okay, so great question. Typically a lot of times when stocks boom on an announcement that Warren Buffett or Berkshire Hathaway has bought the shares, typically it's too late. Typically that's the big bump in the shares that everybody follows Warren Buffett and Berkshire Hathaway into that stock. So you can look at the stock, you can look at HP. I haven't looked at them in a while. I would say after that big bump they got last week on that announcement, I'd say they're probably a little bit overvalued at this point just because of that big bump. But I'm not quite the value investor I used to be. If I were a value investor, I would definitely buy Berkshire Hathaway stock. I think it's a great long-term way to manage your money, have someone else manage your money basically, and that value investing idea. I think it's hard to go wrong with buying Berkshire Hathaway stock. Basically, it's an ETF. It's a value ETF, okay? Because they own about 55, 60 companies right now in that portfolio. So it's going to be diversified across different sectors, financials, equipment, technology, some payments. They're big into payments, so Visa and MasterCard, things like that. So it's going to be a fairly diversified value portfolio. So I would think about Berkshire as part of your ETF portfolio, part of that core portfolio if you want those value stocks and that value thing. Okay, sorry, about 8 months. Clancy per year, dude. You get dividend. So, okay, sweet. Looked at it. No, man, we're fine. Berkshire. Okay, I see a lot of yeah, a lot of questions on that. The Emirate that we talked about earlier, the Armor Residential. Yeah, again, that's that is a 1 year dividend. But a lot of people get that wrong. So don't feel bad about a lot of people saying it's a 1 year and all that kind of thing. It's everybody gets that wrong. Everybody sees 14%. They think, okay, it's a monthly stock. Do I get that every month? That would be too fucking good to be true. Every month would be I'd be investing in that shit. But yeah, it is every year. A lot of people get that, see that and get that mistake right off the top. Okay, look here. But I love the chat back and forth. Usually most of the time people are very respectful in the chat and help each other out. So they're just trying to point you in the right direction. And I love that sense of community that we get here on the channel. I mean, it is a bow tie nation, right? So I love that people are helping each other out and kind of explaining things and doing things like that in the chat. Would you be able to add SoFi shares after last week? Okay, so yeah, I did. I did add some. And one thing, I want to talk about one thing that we're talking about SoFi, talking about buying the stock on the dip, talking about the recession coming up or whatever and that kind of thing. I am starting to add a little bit more to my cash. So not necessarily buying stocks. So when I say don't sell your stocks, don't panic. Don't sell out of all your names, all that kind of thing. Then I don't necessarily mean you need to keep buying everything every time you invest money. I still want you to keep that habit of investing money, putting money into your account every month. Okay, keep that habit. Deposit money from your paycheck into your investing account every month. That doesn't mean you need to buy stocks with it. Okay, I know it's hard. I know you watch YouTube, you watch CNBC, you get 50 stock tips a day, and you're like, oh my God, these look so good. That the bow tie Adonis on YouTube said this was a stock to buy. Well, that doesn't necessarily mean you need to jump into every stock you hear about. Okay, keep some of that money in cash. Okay, keep some of that money in cash for better opportunities, for better prices coming up eventually. I actually bought into a lot of the growth stocks that have sold off so hard over the last year. Since last February, I started buying a little bit more of them in January and in February when they started coming down even more. Because they are starting to look at very attractive valuations, right? So January, February, I started buying Teladoc. I started buying PayPal. I started buying SoFi, right, as they came down, and I ate into a lot of the cash that I was holding. So right now I'm just kind of depositing my money every month, keeping it in a lot of it in cash. That new money, so that eventually, if stock prices do come down, I have that cash set aside. Now I did break that rule and bought SoFi last week because I do think it's such a great growth story. For the future, I do really like the shares right here. So I did buy more SoFi last week, but for the most part, I'm depositing money and I'm keeping it in cash. I'm not selling my stocks, because I do think if you want to sell your stocks or if you want to hedge them, you're going to get a better price here in the next 3 to 6 months to do that. Got the power is he. Jerome Powell singing "I've Got the Power." That's funny. Yeah, Danny. I actually started listening to this. Is funny because I lift. I go to the gym about six days a week, right? And I've actually started listening to on Spotify the Jock Jams playlist, right? Remember that? Anybody older than 30, you remember the Jock Jams playlist or the Jock Jams songs, and "I've Got the Power" is in there. So I'm spinning in my head right now. Jerome Powell singing "I've Got the Power." Step back or I will attack, and you don't want that. What do you think about happening with NVIDIA? Okay, so DTLA wants to know what's happening with NVIDIA. Big important news, just recently from NVIDIA. They actually announced they're asking shareholders to allow them to double the shares outstanding, to double their share count, right? To basically, especially a lot of these tech companies, these growth companies, they want to, they pay their employees, especially their management, in shares, those stock option bonuses, things like that. As well as maybe issue get more shares out there for funding and that kind of thing. So usually they do that on a year-to-year basis, right? Usually they do small increases in the stock, in the shares outstanding, that kind of thing. NVIDIA wants shareholders to approve a doubling of the shares outstanding, right? To double, a huge share issuance. And what that's going to do, that's going to dilute shareholders, okay? That is going to mean, okay, so if you own $100 of shares, $100 of shares in Nvidia, the share count doubles. You've now got pretty much half the investment you used to have. Okay, so I mean, you still have the same number of shares, but now you have to share that. You have to share that with so many more investors. Okay, so they are really massively diluting shareholders. It's going to pass. Most of these requests, most of these shareholder proxy statements, they get just a straight line vote in approval. So they are going to be issuing massive amounts of shares, and that's really going to hurt the stock. Okay, that's going to drive the stock price down. As you see that dilution, it's a good long-term company. I mean, they are the it company, right, for semiconductors. They'll continue to be that. They're the Intel of what Intel was in the 90s and the early 2000s. So Nvidia it's a great company, but a little expensive here. And if they're going to dilute shareholders by twice as much, then it's gonna hurt the shares right there. Kludge, what's your opinion on Alibaba? Actually did a video on Alibaba a few weeks ago, so look for that. I actually bought shares in early March. Alibaba actually. So my cost basis for Alibaba is right around $83 a share. So I got it just before it started going up. I still like it at this point too. I think Alibaba is something like $113 a share. We can actually go in and see where Alibaba is trading right now. BABA. Excuse me. So Alibaba is back down to $102 a share. I still like Alibaba. I still like some of these other Chinese stocks just for what we were talking about earlier. China is aggressively stimulating the economy, lowering rates. That's going to help stimulate the economy, obviously, and going to help push a lot of these stocks. And what's very interesting is China, the government, has actually come out recently and backtracked on that idea that they won't let foreign regulators kind of audit some of the auditing firms in that country. Okay, so the big holdup for Chinese stocks over the last couple of years was that U.S. regulators, the PCAOB, could not audit the auditing firms there in China. So they were at risk of that delisting. It looks like that risk is now coming off the table. Okay, as China gets more, is more accommodative to those requests by the U.S. by the SEC. That risk is coming off the table of those delistings. It hasn't come off fully. They're just talking about what they're going to do. So of course, obviously, that could always change. But they've already made that announcement that they're going to allow some kind of auditing. And they want to avoid those delistings. So that's going to bring a lot of value back into these Chinese stocks, especially, Alibaba. It's hard to deny the value in this thing. This is basically the Amazon of China, the Amazon of everywhere else except the United States, and a very strong valuation case, very strong growth. I think it's a strong stock. I own shares. Like I said, I bought shares in early March and will hold them at least up until $200 a share. I think this stock is worth $200 at least, maybe more. So that's Alibaba. What else here? Okay, is housing market a bubble? Rich wants to know if the housing market is in a bubble. Yes, I think the housing market is in a bubble. Now, again, of course, it's all about your timing on these things. Being early is just as bad as being wrong. Okay, we actually looked at a chart by the Federal Reserve last week that kind of measured housing prices and housing exuberance and bubbly kind of stuff. And it did show without a doubt that housing had moved, nationwide. Obviously, housing is local and all that stuff, but housing nationwide is in a bubble. And 95% confidence on that call for that data. But what you got to understand is it's only happened like 3 times in the past 30 or 40 years that it's reached that level. The problem is it reached that level in like 1999, 1998. And of course, house prices kept going until 2006. So yes, houses are expensive, rent is expensive, all that is super expensive and crazy, especially with interest rates going up, but that doesn't mean it can't get crazier for years to come. So, what I would say is that I wouldn't necessarily be looking at very many housing stocks or your home improvement stocks, things like that. I think those are, obviously, very expensive and primed to come down a little bit more as housing sells off. Like I said, we did see mortgages and refinancing come down quite a bit over the last couple of months. But housing prices themselves can keep on going and will probably not just sell off, not crash, They're certainly not like in 2008. There's still very much a lot of demand for housing. So housing prices probably more stable or up. Some of these housing market stocks probably a little more, a little more tenuous. What else? Banks went down after great earnings last time. Be careful buying into earnings. Well, okay, yeah. Ravencroft points out that banks have been going down even after great earnings. A lot of that is what they're saying about the future, this outlook. And that's really the most important part of earnings is what companies say about the outlook for the rest of the year. A lot of the bankers, the big banks especially, what they're doing is, and this is what I talked about earlier, what they're doing is they're moving money off of their income statements or off of their earnings, putting it back on their balance sheet as those loan loss reserves. Okay, and so again, what this is, we talked a lot about this early last year, late 2020, about those loan loss reserves and what they were doing. Basically, during the pandemic, banks said, shit, we don't know how bad this could get. We don't know how bad the economy could get, the pandemic. We're going to put money aside just in case loans start defaulting. Okay, so just in case the economy gets bad, we're going to put this money aside in this what's called a loan loss reserves account on our balance sheet. It's a safety savings account they have on the balance sheet. What they do, they take that out of their earnings. They take that off of their income statement before it gets to earnings. So it lowers their earnings when they do that. So especially during 2020, what we saw is the banks taking all this money off of their earnings, putting it into this what if, this oh shit account, right? And that lowered their earnings quite a bit. It's starting to do that now. That's why the analysts are expecting Q1 first quarter earnings for the banks to be down 36% over year. Because last year they were doing just the opposite. They were taking the money. They saw, okay, the pandemic isn't going to be as bad as we thought. The loan losses aren't going to be as bad as we thought. So we're going to take this money back out of the loan loss account on our balance sheet and put it back in our earnings. That juiced their earnings last year to super high levels, right? So they were reporting higher than expected earnings. Well, now they're reversing it again. They're looking at, okay, recession may be coming up next year. We're going to start shifting money back again. So what you get here, I think, is if we don't get just a massive recession, if we don't get, a big consumer loan defaults, commercial loan defaults, which I don't think we will. Even as we do get in a recession next year, even as interest rates go up, the consumer is still very strong. Companies' balance sheets are still very strong. The economy is still fairly strong. Even if the recession does come and it's a light recession, we're not going to get those big, massive loan defaults like banks are maybe expecting. All right. So I think, again, you're going to see a situation where maybe next year, maybe later on this year, banks start slowing down that loan loss reserves accumulation, or they even start bringing money back in from those loan loss reserves onto their income statement. So right now, yes, it's hurting the bank stocks because they're saying, okay, we're worried about the economy over the next year. We're going to start moving money into this what if account. Okay, so that's going to lower their earnings, and people are going to be watching for that, and the bank stocks are going to be a little bit weaker. But what actually happens is, then they have that huge what if account of billions, hundreds of billions of dollars that they're going to use as ammunition to boost their earnings towards the later end of this year and into next. So it's part of the reason why I'm positive on banks. Okay, what else? Okay, so we're heading on into an hour and a half. I'm going to cut this one off. If I didn't see your question, go ahead and ask it in the comments below. I'll try to get to it later on while I'm at the gym. Again, I appreciate it. I love seeing everybody here in the chats every Monday morning at 9 a.m. Eastern before the market opens, just kind of trying to get you ready for the market. And I will see you in the next video.